Reality is truly setting in for Disney. No amount of obfuscation, manipulation, or sleight of hand can actually be employed to mislead investors with the false promises of streaming left unfulfilled. The ballooning costs for content and, of course, the licensing deals have really come at an incredibly high cost for the company. Now that I've digested some of the numbers over the weekend, I think it's time that we dive in here. Here we go. So, with Mr. Grant Gregory trying to bounce back from his channel theft and deletion, I imagine everything will work out okay eventually. I'm back to edit my first few videos in quite some time, so bear with me and forgive the lack of polish that Grant brings to my video content. At least we have some interesting stories to talk about this week, even if it's done in my same clumsy style. Disney actually reported their Q4 earnings last week, as all of you probably know at this point. And to some extent, they were impressive, but at the same time, they were also quite disappointing. And if you watch any of my friends like Valiant Renegade and WDW Pro and many others who do some great analysis, well, you've already known some of these things and probably a few of the elements that I'll talk about in this video. If not, I encourage you to go and check out those wonderful content creators because Valiant Renegade does a great job and so do many others. In fact, I'm going to try to include their links down below because WDW Pro does some excellent journalistic work over there at that Park Place. So on we go. We're going to look at what Disney thought was going to be very good news for investors. They added 12 million subscribers in Q4. That's quite a lot. In fact, it is very important, and I'll tell you why later in the video. But that number, of course, even with what it represents in the end, wasn't quite enough. Last Tuesday, the stock, in after-hours trading, lost 10% of its value. That was stunning, driving it well under $100 a share, down to, I believe, $90.01 at the lowest point. It might have been lower. I don't know. I was basking in some schadenfreude at the time. So, as of this morning, it's still trading at nearly, $4 down from its Tuesday close. And of course, like I said, it was kind of a roller coaster, although somewhat upward trajectory the rest of the week. For the year, it's in a 20% deficit year to date. That's actually a big problem. And I don't think it's going to go away anytime soon. And I think it may lead to more instability for the stock that is stuck in a bearish cycle. The analysts are not optimistic in that regard. And of course, I'm agreeing with them completely. Investors of all stripes were sold early on by this idea of the subscriber metric. And I don't know why they wouldn't have been, because to be fair, it was the only thing that was being hyped. There wasn't any financial history there. It was no historical data that anyone could reflect on to feel like, they were understanding any kind of financial performance. It was going to take some time to create, their own version of Netflix. And all of the entertainment companies that pursued this goal were all in the same boat. So they all reported subscribers, which was the only thing that a lot of people paid attention to when it came to Netflix, so it made a lot of sense. And the sentiment early on was that Disney's experience with their other types of streaming products, such as Hulu, well, they felt like maybe they could make this new flagship streamer, for lack of a better way of describing it, more profitable and very profitable in a flash. Jumping forward to now, however, investors want to see a return on that investment. And you know what? I don't blame them. I like to see returns on my investments as well. So they're bothered that, the content spend has been completely unfettered at Disney and many of these other entertainment companies, to be sure. And it's been beyond costly because it's not been reflected in an increase in the ARPU. And we'll get to more of that in just a moment. It also hasn't contributed substantially to entertainment earnings. In fact, it's kind of been a drag. Now, the fact that Disney recently, and this is important, they bypassed Netflix and the overall number of subscriber holders, at least across all their platforms, not Disney Plus specifically, but add in Hulu Plus and ESPN Plus and some other things, and they're doing good. They just passed Netflix, so they've just not been able to show the kind of profits that Netflix was able to eke out, although it took Netflix much longer to get there. To be even more fair, because I always like to be, Disney didn't promise to be profitable. They didn't promise profitability until 2024, at least for their Disney Plus service. But now they're coming into substantial macroeconomic headwinds for the foreseeable futures, as well as pretty much every other company. So this kind of growth is increasingly unlikely. I think a lot of these companies are going to go backwards. And the elephant in the room here is how much it costs Disney to actually make their direct-to-consumer content versus, how that content is actually paid off. And that number this quarter is, it's staggering. It's had a staggering negative impact on the company. And the operating loss for Q4 totaled over $1.47 billion. That's more than double the operating loss year over year for the same quarter last year. That's telling. And now we're going to get to the metric that is starting to catch on with investors, one that I've been talking about for a long time, and many of my friends have as well. It's called ARPU, average revenue per user. This number actually fell 5% year over year, and that is not good. It's also not going to get better as things move forward because, remember, those substantial macroeconomic headwinds, well, they aren't going to get better because it's going to start to drive something called churn. And those churn numbers are going to be up substantially. In fact, there's evidence they already have been. In addition, we are seeing something else for Disney Plus, and that is November is the last month of this super mega deal that was offered to early adopters of Disney Plus. And that gave them 3 years of the service for a flat fee that was, the equivalent of $3 a month. This means that if Disney didn't take aggressive actions to actually maintain those subscribers, they will likely be losing a decent percentage of them. Some people have speculated 50% or more. I don't know that it'll be that high, but there have been some reports that over the course of the last 18 months, people with expiring credit cards, debit cards, etc., at least as far as the expiration dates, have been getting messages when they are logging in to update their information in hopes of course, charging those customers at the renewal point. And those people will be charged a substantial increase. In fact, everybody will be charged a substantial increase as prices go up for Disney Plus across the board. And there, of course, have been significant reports that the number of those early adopters rarely log into their account anymore, which means they may not be able to retain them at all. And people probably may not have noticed that their account went fallow. So there is potential that the churn number in November could reach its highest level ever for Disney Plus, maybe even for any streaming service. Of course, that remains to be seen. In any event, Chapek and company have been relying on increased interest and revenue starting December 8th with the inclusion of their new ad tier for the streaming service itself. Now, I'm going to wonder, maybe even speculate, that there was something there that's designed to recapture those folks who think the product has become too expensive. Obviously, it's time to somewhat near a renewal, so maybe they'll be able to push people into the commercial or the ad tier product. And it's obvious that they're going to expect a boost in ARPU from the ad tier, which it could work out. I mean, look at what Peacock does with their ad tier. But that, of course, remains to be seen as well. Now, we finally get to something called the partner deals, like Verizon and a lot of these other entities, Comcast, and so on and so forth. Those are all coming up on expiry as well. And again, those are already offered at a pretty deep discount. So will those partners themselves abandon the product because it does cost them a little bit of money, or will they continue to offer those deals to their consumers? I don't know. They're dealing with their own macroeconomic headwinds, so I would say it's 50-50. And now, finally, we're going to step outside the streaming service itself for Disney, because that's not the entire conversation. And one has to wonder, when you're looking at what the performance will be for the theme park business and, of course, for the live sports broadcasts that essentially continue to prop the company up. Those areas are actually also in a downturn, despite the fact that there was just huge performance in the theme parks in the last quarter. So based on newly announced fake discounts for Disney properties and cruise lines to, of course, increase interest in having a Disney vacation, I would say that those segments are going to start to have difficulties of their own. And one thing to look for, in fact, if you're wanting to track this yourself at home, is look for the return of a dining plan or a free dining plan included as a benefit of a pre-planned family vacation, or perhaps tickets included with a resort booked vacation through Disney or an affiliated travel agency. I would say that those would be the markers of whether or not the theme park business is in really the robust health that you were told by Miss McCarthy and Mr. Chapek. Of course, when we come to the end of the video, I ask you, what do you think? Do you think that the Disney Plus service will continue to push forward to profitability? And what do you make of the recently revealed layoffs at Disney and, their entertainment entities? Do you think those are going to have an effect on the bottom line? They have an effect on the stock price? I don't know. Interesting questions all. So please feel free to utilize the section down below and just give me your comments, because you and I can then have a conversation about what the future of Disney and many of these other entertainment enterprises might be. In fact, we're probably going to have a pretty decent discussion about that on the Tuesday tirade with Tom from Midnight's Edge tomorrow. And of course, I'm always going to encourage you to support other independent creators such as Midnight's Edge After Dark, obviously I mentioned Valiant Renegade, and of course WDW Pro, and all of the many channels that I hang out with on a regular basis, and I'm proud to call them my friends. Because again, the only way to rise is with your support. So if you come across content that you enjoy or a creator that you like, be sure to subscribe. Hit the like button on the videos that you enjoy. Be sure to share out the content you think is valuable to yourself and others. And of course, make those comments because they drive engagement and increase the subscription base. And I truly appreciate that. And with that, be sure to take care of yourself, take care of others, wash your hands, of course, because it's good hygiene. And until next time, bye.
Thanks for visiting today. Be sure you're subscribed and hit that for alerts.
Yay!
Of course, like and share all of the videos that you can, as it helps with the algorithm. Have a great day.